All right, let's cut straight to it. Keysight Technologies just released their Q3 2025 earnings, and if you're looking to understand what's driving their impressive numbers and where they're headed next, this deep dive is definitely for you.
Yeah, we'll distill the core financial highlights. We'll look at their segment performance and really give you a clear picture of their forward-looking guidance. We'll cut through the data to get to those key insights.
And what a story these numbers tell. Keysight's president and CEO, Satish Dhanasekaran, he really highlighted the strength, didn't he? Said they delivered strong results this quarter, exceeding the high end of our guidance for both revenue and earnings per share.
And they didn't stop there.
No, he also announced they're raising our outlook for the full year once again. I mean,
Wow.
that's a pretty bold statement, right? Especially in today's market.
It really is. Shows a lot of confidence.
So let's get right into those core Q3 2025 financials because the figures themselves, well, they paint quite a picture. Keysight reported revenue of $1.35 billion. Now, that's a significant jump from $1.22 billion in Q3 2024.
So that's an overall 11% year-over-year growth. Pretty strong.
Exactly. And their non-GAAP net income climbed to $297 million, up from $275 million same quarter last year.
Which translates nicely to the bottom line per share.
It does. Non-GAAP earnings per share, $1.72. That's up from $1.57 per share in Q3 24. And it wasn't just about income. Look at the cash flow. Operations generated $322 million.
Wow. Yeah, up from $255 million last year. That's robust.
And free cash flow hit $291 million. Again, a solid increase from $222 million. And, this actually marked their third consecutive quarter of overall revenue growth. That feels like a trend.
Absolutely. And what's truly fascinating here isn't just hitting the targets, but exceeding their own guidance. This isn't just, good fortune. It signals that their investments, say in advanced node testing or high-speed comm standards,
Right.
those are translating directly into market share gains. It suggests, well, really robust underlying demand and, frankly, effective management. Especially compared to maybe some competitors who are slower on the uptake with these tech shifts, their strategy seems to be paying off.
That definitely points to strong execution. But, everyone always wants to know what's next. So what did Keysight's crystal ball show for Q4 and the full year?
Okay, so for Q4 2025, Keysight projects revenue in the range of $1.370 billion to $1.390 billion.
Okay, another step up, potentially.
Yes. And for non-GAAP earnings per share, they're looking at a range of $1.79 to $1.85. And that's based on roughly 173 million diluted shares assumption. Just quickly, that diluted shares bit means they're factoring in potential shares like from stock options.
Right, to give a more conservative EPS picture.
Exactly, a comprehensive estimate.
And zooming out to the full fiscal year 2025.
They expect revenue growth to be approximately 7%. And non-GAAP EPS growth is projected around 13%. That's at the midpoint of that Q4 guidance we just mentioned.
Okay, so continued growth expected.
Yeah, and if we connect this to the bigger picture, these projections, they aren't just one-offs, right? They indicate sustained confidence in Keysight's market position, their strategic moves. It suggests management sees this strong performance as, well, a consistent trajectory, driven by their core strengths and staying ahead on these critical tech shifts.
That's a pretty solid forward look. But okay, to really get a handle on this performance, we need to, peel back the layers, look at their individual business segments. Where exactly is this growth coming from?
Absolutely, that's where the details are. Keysight has two main segments. First, their Communications Solutions Group, or CSG. They reported revenue of $940 million in Q3,
Okay.
and that's up 11% from the prior year. Now, CSG, that's about test and measurement for things like 5G, satellite comms, high-speed data centers, that kind of thing.
Got it. So what drove the growth there?
It was pretty broad. A 13% increase in commercial communications and 8% growth in aerospace, defense, and government.
Okay, let's break that down. Commercial comms.
So within commercial comms, they saw double-digit increases in both wireline, think fiber optics, and wireless, like 5G and beyond. And their order growth there really reflects continued investment in, guess what, AI data center infrastructure.
There's AI again. And the defense side.
Aerospace, defense and government, or ADG, saw strength in the U.S. and Asia. They reported double-digit order growth both year over year and sequentially. That's fueled by, well, ongoing global government and defense spending. Seems pretty consistent.
Okay, that's CSG. What about the other segment?
Right, the Electronic Industrial Solutions Group, EISG, also performed strongly. EISG revenue was $412 million in Q3, also up 11% year over year. Now, EISG, that provides tools for like general electronics, semiconductors, automotive, more foundational tech building blocks.
And growth drivers there.
Pretty much across the board. Semiconductor, general electronics, and automotive and energy sectors all saw growth. In semis, wafer test solutions revenue grew by double digits. This is because foundries and IDMs.
The chip makers.
Exactly. The chip makers and designers, they continued investing heavily in AI-driven advanced node tech, memory, and also silicon photonics, SiP. SiP is, what was really exciting, it uses light instead of just electricity for super-fast data transmission, crucial for AI data flows.
Makes sense. And general electronics.
Revenue there grew for a second consecutive quarter. That was due to strength in advanced research, kind of cutting-edge science, and digital health. Think medical devices, remote monitoring, that sort of thing. They saw broad demand driving double-digit order growth there, too. Even automotive orders, while maybe stable year over year, they did improve sequentially from Q2.
Okay, it's really clear from those breakdowns, AI keeps popping up. It's not just a buzzword. It seems like a significant tangible driver across multiple areas for them. Data centers, advanced chips.
Absolutely. And this is where their portfolio integration becomes so critical, you see. Keysight's test solutions are vital. They ensure the reliability, the speed, the efficiency of the very chips and networks powering AI. They're not just like benefiting from the AI trend, they're providing essential plumbing for it. Makes them indispensable.
So they're deeply embedded in that whole ecosystem.
Exactly. The segment data clearly shows them capitalizing on these tech landscapes, positioning their solutions right at the heart of the innovation. Oh, and it's probably worth noting, their overall core operating margin improved too, up 110 basis points year over year to 25.4%.
Which is, what, 1.1 percentage points?
That's right. A strong indicator of not just growth, but also efficient operations alongside that growth.
That improved margin really does underscore their efficiency. So, okay, beyond the great quarterly numbers, what else is Keysight doing strategically, to make sure this is sustainable strength, not just a flash in the pan?
Good question. Their presentation highlighted several strategic pillars. First, their backlog. It stands strong at $2.4 billion. And they have strong scheduled shipments for Q4, which really backs up that raised full-year outlook.
Provide some visibility then.
Definitely. On the financial health side, year-to-date free cash flow is $1.1 billion. Excellent cash conversion, as we noted. Plus, they're returning capital to shareholders. Q3 saw share repurchases, about 300,000 shares for $50 million.
Okay, what else?
Something particularly strategic is their focus on recurring revenue. Software and services made up 36% of overall revenue, with recurring revenue specifically at 28%.
Why is that so important?
Well, it signifies a deliberate shift, right, towards more stable, predictable income streams. It's not just about predictable money, though. It embeds Keysight deeper into their customers' R&D cycles, creates stickier relationships, future growth opportunities, less tied to maybe economic ups and downs.
Makes sense. Building a more resilient base.
Precisely. They're also active on the acquisition front. Updates on Spirent regulatory clearances, they expect that to close in Q4 FY2025. And their deals for Synopsys Optical Solutions Group and ANSY's PowerArtist are moving towards final regulatory approval, too.
So inorganic growth is part of the plan, too.
Seems so. And finally, they're tackling external pressures head-on, specifically tariffs. They have a multi-pronged approach to reduce the impact. They noted the incremented gross impact of the August 1st tariff increases is about $75 million annualized.
Okay.
But they're on track to fully mitigate the earlier April tariffs by Q1 of FY26. And they aim to fully mitigate these newer August tariffs within the first half of FY26.
Wow, okay. So it sounds like they're actively managing those external pressures, not just, riding the market waves. That proactive approach, like with the tariffs, signals some pretty robust, foresightful management. They're not leaving growth to chance.
Seems that way. They're trying to actively engineer it, manage the headwinds.
Okay, now, let's do a quick deep dive on something you see in pretty much every earnings report. GAAP versus non-GAAP numbers. If you're maybe newer to looking at these reports, it can feel like a different language. You've probably seen GAAP and non-GAAP mentioned. What's the actual difference, and why does Keysight, like most companies, use both?
That's a really crucial point for understanding any company's financials, you're right. Keysight uses non-GAAP measures, primarily, they say, to analyze performance through the eyes of management, and also to make it easier to compare to past periods and competitors. Essentially, they're trying to give you what they see as a clearer view of the core operational performance by stripping out certain items they consider non-recurring or non-operational.
Stripping things out, like what?
Yeah. Well, first, it's really important to remember these non-GAAP measures are supplemental. They are not a substitute for GAAP. GAAP, generally accepted accounting principles, that's the standard, legally required way to report financial results. Designed for consistency across all companies. Non-GAAP is, let's say, an alternative view management thinks shows underlying trends better.
Okay, so what gets adjusted out, typically?
Common adjustments include things like amortization of acquisition-related balances. Those are non-cash expenses from past deals. Share-based compensation expense is another big one. That can vary a lot. It doesn't directly impact daily cash flow, though it is a real expense. Also, acquisition and integration costs, not seen as normal recurring operating expenses. Sometimes restructuring costs or other infrequent items. And they usually adjust taxes, too, to reflect a kind of consistent estimated rate for their non-GAAP math.
So it's about getting the full picture, but also understanding this specific lens they want you to see their core business through. They're essentially saying, here's how the fundamental operations are doing if you set aside these specific, often one-time or non-cash items.
Exactly right. And while these non-GAAP numbers can offer a clearer view of that core operational performance, it's really crucial to remember the excluded costs, like share-based comp. Those are actual expenses. They impact the company's bottom line. They can dilute shareholders. It's about how management chooses to present operational performance for a specific analytical purpose. Not saying those costs vanish. You always want to look at both GAAP and non-GAAP figures. Get the complete understanding, avoid, potential misinterpretations.
That is excellent advice for anyone wading through earnings reports. Now, as with any forward-looking statement, right, especially for a global company like Keysight, there are always factors that could shift the outlook. Keysight is clear about this, and it's important we keep these risks in mind, even when the numbers look this strong.
Indeed. You have to consider the context. They highlight several types of risks that could impact future performance. Things like, the broader impacts of global economic conditions, inflation, recession fears, that kind of thing. Potential slowing demand for their products or services. That's always a risk.
Sure.
Volatility in financial markets is another one. Could mean reduced access to credit, higher interest rates, geopolitical tension, conflict outside the U.S., that's obviously a big factor for global companies, export control regulations, compliance complexities, and just basic stuff like customer purchasing decisions and their timing, orders getting canceled.
So lots of external variables.
Yeah, and it raises that important question, right? While the current results are strong, how will Keysight continue to strategically navigate these variables? It's something management is constantly monitoring, you can be sure.
Okay, so wrapping this up, what does this all mean for you, the listener? Keysight's latest earnings report, it paints a picture of a company really capitalizing on key tech trends, especially around AI and defense, while also actively managing its finances, its operations, and those external challenges we just talked about. It's a fascinating look at how a company in this test and measurement space translates cutting-edge innovation into, pretty robust financial performance, and how they plan to keep doing it.
Yeah, the deep dive into their segment performance and the future guidance, it really highlights their strategic focus. And maybe something to think about is how these specific investments Keysight's customers are making, in AI data centers, advanced semiconductors, global defense, how those reflect the broader technological and economic currents shaping our world right now. What other industries might be seeing similar, maybe less obvious, shifts in their investment patterns? Driven by these same fundamental tech advances and geopolitical factors, it's definitely a question worth pondering as we watch this global tech landscape just continue to evolve at, frankly, an incredible pace.